Hi, this is John Persinos, editorial director of Investing Daily. To view our full range of publications, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. And welcome to my video interview with Jim Pearce, Chief Investment Strategist of our flagship publication, Personal Finance, and the premium trading service, Mayhem Trader. Jim is a seasoned stockbroker with over 40 years' experience covering Wall Street, and with the markets getting wobbly and volatile, I thought this would be an opportune time to tap his expertise and try to find out what direction the markets are going and get you some actionable trading advice. Jim, thanks for being here. How are you doing?
I'm doing great, John, and you're welcome. But it's not like I really have a choice. If I don't do this call, I'm fired.
Well, over the years as a stockbroker, you've amassed enough of a personal fortune, so you don't have to worry about paying your bills.
I don't, John, but please don't tell my wife or kids that, or they'll start wondering why I keep coming into the office.
It's probably because you want some peace and quiet.
Exactly.
Anyway, let's move to the first question. Jim, we're starting to see bad breadth in the market, and I'm not talking about halitosis. It means that fewer and fewer stocks are participating on the upswing. Is this a red flag that a correction is imminent?
John, anytime there are more stocks going down in price than going up, that's a sign that investors are losing confidence in the stock market. That also means most of the money is going into companies that are perceived as being more resilient to a weaker economy. We saw the same thing happen last year, especially with big tech stocks. They were viewed as beneficiaries of the coronavirus pandemic, while severe social distancing restrictions forced most of us to work, learn, and shop from home. That trend reversed during the first half of this year once vaccines for COVID-19 started being administered to the general public. However, the Delta variant of COVID-19 has renewed fears that the economy may once again have to shut down. Since June 1st, the tech-heavy NASDAQ Composite Index has gained about 10%, while the Wilshire 5000 Total Market Index is up by only about half that amount.
You know, September is historically a volatile month, and as September unfolds, we're seeing more and more choppiness in the market. What's your view about the rest of 2021? Do you think that a correction will happen before the year is out?
Actually, John, I believe a stock market correction of 10% or more could easily happen within the next 4 to 6 weeks. In October, we'll see the labor and inflation reports for this month. At the same time, most companies will release third quarter results along with guidance for the remainder of this year. If any one of those data points comes in worse than expected, then that may be enough to trigger a correction. And if all of them are disappointing, then a quick stock market correction is likely, in my opinion. Bear in mind, the overall stock market, as measured by the S&P 500 index, is up nearly 20% so far this year, so a correction of that magnitude would not be disastrous. Also, it's been more than a year since the stock market has gone through a correction, so we're due for a pullback.
That makes a lot of sense. You know, earlier this year, we started to see a big market rotation whereby investors rotated from growth stocks to value stocks. But then right around midsummer, we saw this market rotation reverse, and investors started to pile back into growth stocks. This phenomenon was largely fueled by a rally in big tech stocks again, even though big tech stocks have gotten pricey. Investors have piled into the mega cap Silicon Valley darlings as a measure of safety because these are familiar household names. Do you think large cap tech stocks can maintain this momentum as 2021 draws to a close?
Well, I believe large cap tech stocks can maintain their momentum into early next year. They're holding a lot of cash and can use that money to repurchase their own stock to maintain share price stability if they feel that's necessary. Also, most tech companies have business models that are quite flexible, so they can quickly ramp up production during good times and almost as quickly scale down during tough times to keep costs under control. Also, demand for tech products and services tends to remain fairly constant even when consumers cut back spending on other items. However, all of that may not be enough to offset the potential damage done by rising interest rates. In addition to slowing down the overall economy, higher rates would decrease the present value of future earnings. That would be especially harmful to big tech stocks since most of them trade at very high multiples to future earnings.
You know, we're starting to hear a lot of taper talk from the Federal Reserve. The U.S. Central Bank has suggested, hasn't said definitively, but has signaled that it will soon start winding down its asset purchases. When do you think taper might begin, and how dramatic will it be at the start?
Yeah, and that's the question on everybody's mind right now. How soon the Fed begins tapering will largely depend on how the jobs and inflation data for September look when those reports are issued in October. Lately, inflation has been rising faster than expected, while the economy has been adding new jobs slower than expected. Thus far, the Fed has justified its very accommodative monetary stance on the grounds that job growth is more important than tamping down inflation in the near term. However, if all we're getting out of this is rising inflation without job growth, then the Fed may decide to shift gears. When the Fed does begin to taper, I expect it'll start very slowly and then gradually increase over time. Bear in mind, even when the Fed is tapering, it is still injecting cash into the financial markets, but at a decelerating rate. So that shouldn't destabilize the financial markets.
Yep. Jim, as 2021 draws to a close and the fourth quarter looms on the calendar, what great salient investment theme do you think will stand out in 2022?
Yeah, and it's not a sector play or anything like that. It's just that so much attention has been focused on big tech stocks lately that the rest of the stock market has gone largely ignored. There are many companies that have been posting exceptional operating results lately, but their share prices do not fully reflect their true worth. I believe it is those stocks that are poised to take off soon. As the smart money on Wall Street starts taking profits in big tech stocks, that same amount of money going into smaller companies will have an outsized impact on their value. I've been following this trend for the past several months, and I believe that transition could already be underway. If I'm right about that, then a lot of money can be made in the months to come by owning these kinds of stocks.
That sounds very interesting indeed. Jim, thanks for your time.
You're welcome, John, and thank you.
You betcha. My colleague Jim Pearce has created a tool that lets him pinpoint lightning-quick profit opportunities, one that he believes is unlike anything else you've ever seen. It's also a tool that won't be available to anyone else, not even existing personal finance subscribers. Jim will only be sharing the trades it pinpoints inside his new advisory, Personal Finance Pro. Keep an eye out for an offer from Investing Daily. Consult the article that accompanies this video on the Investing Daily website for details. Well, thanks for watching. That should do it for now. Please stay safe and stay invested.